Welcome to This Week on Wall Street, your essential briefing into what matters most in markets. I'm Matt Weinschenk, the Director of Research here at Stansberry Research, and here is something that might shock you. While everyone's been obsessing over AI stocks and tariffs, the smartest money on the planet has been quietly buying massive amounts of one particular investment, and of course, I'm talking about gold. And today, I'm going to show you why gold could easily hit $5,000, a prediction that seemed reckless just a few years ago, but now it looks almost obvious. So we'll break down the economics, the desperate moves central banks are making right now, and I'll bring in our trading expert who's identified a technical pattern that could send gold absolutely parabolic. But first, let me tell you what's really driving this gold rush and why it's just getting started. You know, I've been watching markets for 2 decades, and I've learned one thing. Nothing drives prices higher like pure desperation. And right now, people are desperate for gold. Professional investors from massive institutions to central banks are scrambling for an investment that they can actually count on. And here's why that's happening right now. So, for decades, U.S. stocks, bonds, and the dollar were the ultimate safe bet, the no-brainer investment. But something fundamental has shifted, and the smart money is now running for the exits. It started with tariffs shaking up the global economy, right? Suddenly, investors began questioning the world order they'd taken for granted. And the result? That's what's now called the Sell America trade, a large and, I believe, persistent sell-off in U.S. stocks, bonds, and the dollar. But that's just the beginning of this story, because I'm going to be straight with you. We've all heard the warnings about America's debt problem for years, and for the longest time, those warnings seemed overblown. The debt kept climbing, but nothing bad happened. And I think we all assumed we'd deal with it when we had to. Well, guess what? We have to deal with it now. After the massive spending during the financial crisis and the pandemic, our debt has become completely unsustainable. And here's the kicker. The economy is still strong right now, right? Tax revenues are flowing. This should be when we're cutting the deficit. Instead, Congress just can't or won't stop spending. So the new budget working its way through Congress will add another $2.4 trillion to our debt by 2034, and the world is saying enough. Global markets are rejecting America's spending spree by dumping U.S. Treasuries. The 30-year bond yield has rocketed from 4% in September to nearly 5%, and that's the highest since the financial crisis. But here's what should really terrify policymakers. Now, normally, higher interest rates mean a stronger dollar. When you can earn more on U.S. bonds, global investors buy dollars to invest in our treasuries, and that pushes the dollar up. But that relationship has completely broken down. Bond yields are rising because investors don't trust U.S. bonds anymore, and those higher yields aren't attracting money to the dollar. They're scaring it away. Now, you might be saying this is all fascinating, but you promised you would talk about gold. I've only talked about the dollar so far, but the thing is, the dollar story is the gold story. They're two sides of the same coin, right? There's a mechanical relationship here that's as reliable as gravity. Gold is priced in dollars. When the dollar weakens, gold gets more expensive. It's really that simple. So think about it this way. Every gold chart you see is really showing you two things: the value of gold and the health of the dollar. And since gold is the ultimate store of value, when you see gold climbing, you're also seeing the dollar falling. So dollar down, gold up. It's that simple. But there is a second, more powerful force at work. The dollar is the world's reserve currency. But as investors watch it decline and they see America struggle with its budget, they're desperately searching for alternatives. Now, for years, the dollar's best argument was, well, there's nothing better, right? Nobody wants to rely on China's yuan. Japan's in long-term decline. The euro is built on a coalition of sovereign nations instead of a single country, which makes it really shaky currency for a reserve currency. So if you don't trust the dollar, and now you don't trust these other currencies, what's left? And the answer is, of course, gold. Pure and simple. So here's where this gets really interesting. Central banks are hoarding gold like never before. In each of the past 3 years, they've added more than 1,000 tons to their gold reserve, and that's unprecedented. And now in 2025, the buying has only continued. According to the data out this week, just in the last quarter, India bought 3 tons of gold, Czech Republic bought 5, Kazakhstan 6, China 12, and Poland bought 48 tons of gold in the last quarter. And that's real money. 48 tons of gold is worth about $5 billion. So listen, central banks don't make snap decisions. They plan decades ahead. This isn't a fad. It's a fundamental shift in how the world stores wealth. Surveys from the World Gold Council show that 69% of central banks expect gold share of their reserves to be higher in the next 5 years, and 62% said they expect to hold less in dollars. And those surveys came before the tariff and dollar troubles. So listen, this isn't stopping anytime soon. And it gets more explosive when you think that demand is going through the roof, but supply has been flat for over a decade. Gold prices have been relatively low for years, so mining companies didn't invest in new production. Output's been essentially flat since 2010, and it takes years to ramp up gold production. So we have massive new buyers and no new supply. In economics, that's called the perfect storm. So here's my take. The Sell America trade is becoming a buy gold trade. Countries currently hold about 22% of their reserves in gold, so there's enormous room for that to grow. And remember that total global currency reserves are around $6.6 trillion, so even moving a tiny percentage of that into gold can create massive upward pressure on the price. So we used to laugh at predictions of $5,000 gold, but with gold already at $3,500 an ounce, rising geopolitical tensions, dollar concerns, and central bank buying, I'm looking at gold easily hitting $5,000 by 2026. But I wanted to bring in someone who thinks gold might possibly go even higher. Now, I'm primarily a fundamental investor, but I want to show you what our technical trading expert sees in the chart. So Greg Damon is our trading specialist. He's worked for $1 billion hedge fund and pension funds. And I'll be honest, I used to be skeptical of technical analysis. I didn't really think that chart patterns worked. But after watching Greg trade every day for almost 7 years now, showing readers more than 30 trades that doubled their money, I have become a believer. So Greg, thanks for joining me. I'll just set you up with the open question. Walk us through this gold setup that you're seeing right now.
Yeah, thanks for being here, Matt. And you can see here, I shared a chart here, but this gold, what really gold reminds me of right now is something called a turtle market. And there's a great book called The Way of the Turtle. And it goes back to a group of traders who were basically trend followers. But, you know, you've heard the saying, you know, buy low, sell high. And as an investor, as a trader, that is absolutely true. That's what you want to do. But they had a different way of looking at things. And theirs was buy high, sell higher. So gold to me is fitting within that framework. And you can see here, going back to 2020, it was in a 3-year range, okay? And then we finally broke out. And what I find interesting about this pattern, again, this is where buy high, sell higher goes. And you mentioned it earlier that, you know, it's on desperation. You know, a lot of people think that just because the market has gone high that it can't go much higher. And I don't think that's the case here. So I think it can go much higher. But what we're looking at here, and this is just very simple technical analysis, okay? After the breakout, we've been in this nice uptrend. We broke out above this uptrend. This is back, you know, in April with the tariff situation. And then we bounced off support, and now we're rallying again. So the way that I'm looking at this is as long as this support level holds, okay, and this low is back, you know, in mid-May, call it 3 weeks ago, around 31.20. You know, this is a scenario where if we do get those dips, even though we've had this huge run, this is something where I think we can run a lot higher.
So, yeah, I mean, I like to say the most likely thing for a stock after it hits a 52-week high is to hit another 52-week high, right? Momentum is a real feature of markets. But let me ask you some questions about this technical analysis to make sure I understand it. So, like, the concept of technical analysis is that by watching the price, you can see almost everything you need to know, and you can see how investors are thinking. So something like you talk about support. When gold bounces off that $3,200, that shows there are buyers who think that's a cheap price. And previously, it couldn't get past that $3,400 because investors thought it was too expensive. But then when you see it break through that old high, that suggests like the bulls are thinking differently than they were a month ago. Is that kind of how you read these things?
Yeah, in a way. a little bit more. So there's a little bit more advanced ways to look at it. But
I've got the kindergarten version.
Yeah,
here,
instead
I'm
of
the
on a basic level, that's absolutely right. And you'll have, whether it's trend following systems, quantitative systems, whatever it might be, they're not looking at the same way, but they're trading it the same way. And then it becomes a matter of, risk management. It's like, or at least where the risk is. That support, if that breaks, you'll likely see the market, trade lower. So again, from just a very simple standpoint, as long as this support holds, it remains in that, turtle-like market where we can see much higher highs.
Yes. So the outlook for gold is bullish until it breaks down, and then you would think we're in maybe a new regime, something like that, right?
Correct.
Okay.
Yes.
And then you've showed me, you see an even bigger rally coming when you zoom out and look at a longer-term pattern.
Yeah. So this is a shorter-term pattern. And again, I outlined this is the support just from that breakout, and now we're in this higher high situation. Okay. And you can kind of see it. I mentioned this on my show, Diamond's Edge Live, yesterday, or on Wednesday. And, essentially, as long as we hold that support, we can rally up to the new highs around 3,500. All right. That's great. Now let's look at the long-term chart. Let's look at this 5,000 level, right? And this is where things get really crazy. And I'll preface it, what I'm about to go over, with saying this isn't going to happen in a straight line. No market moves in a straight line. At least that isn't in some type of, like you said, desperation. That's when things go parabolic and things get a little crazy. So the way that I look at this, and I won't get into the nuances of what all these 1s, 2s, and 3s, and 4s, and 5s, that's Elliott-Wave. Again, you can go on to my Diamond's Edge Live or 10 Stock Trader, and I cover this on the daily basis. But essentially what I've outlined here is from this low, as long as these lows hold, again, let's call it 32.10, I've outlined a scenario heading into 2026, probably into 2027, where based upon the rules of this technical strategy, you can see here, I actually have it as a high, probably into 2027, around 6,000.
6,000. Okay, so let me try and summarize this again. You got the fundamental view, which I delivered, which I know you know all that stuff too, Greg, not to say you don't know that. But when you reading the price action on gold, you see it's really set up for a short-term gain, like a nice little pop here, something like that. But if you zoom out, everything's kind of set up for a larger bull run. And then if something changes with fundamentals, wars, geopolitics, something like that, gold is a safe haven that people flock to. So there's really definitely an opportunity here. And that chart up to 3,000, 3,500 looks really impressive, but it really might only be the beginning.
Absolutely. I agree. Okay. I agree 100%.
Okay, cool. So for someone looking to trade gold, what kind of instruments do you like for that? What's the first one they should be looking at?
So if you just want to purely play gold without buying coins or buying bullion, GLD is the ticker, and that tracks the spot price of gold very well. So you can just buy the ETF, and there you go. If you want a little bit more leverage, you can look at the gold mining stocks, which GDXJ. And even more leverage is NUGT, which is a leverage play on GDX. So you're getting a lot of leverage there.
Yeah. And I will just, I think you agree, Greg, those leverage plays, ETFs only work in the short term. It's not as easy as buy, hold, and get triple returns. They're kind of a short-term trading instrument, so people should be careful with that. Well, Greg, that's incredible analysis. Thank you for joining us. Whether you're a fundamental investor like me or a technical trader like Greg, the story's the same. Gold is setting up for a historic run, and you can learn more about both the fundamentals and technicals driving gold at Stansberry Research. We produce free, high-quality research on gold, commodities, and so much more. Plus, you'll get an update on Greg's latest ideas. So go sign up free at stansberrydigest.com right now. And, of course, make sure to hit like and subscribe here on YouTube so you never miss our market insights. And you'll also, by subscribing, you'll be notified when Greg does his weekly live video Wednesday mornings, 8:45 a.m. You definitely don't want to miss that. So that is all for today. I'm Matt Weinschenk, and I will see you next week.